Welcome back to another lesson at AllGen Academy. So today we're going to start talking about an important concept, and that's the concept of diversification. In previous lessons we've talked about stocks, bonds, mutual funds, alternatives, different types of investments, and it's great to start learning about them, but today we're actually going to start bringing them together, Jason, and we're going to talk about, once you understand the investments, how do you create a portfolio that minimizes some risk, that makes sense for me? And the first concept is diversification. Now, so let's dive right into it, and the first issue to discuss in diversification is asset allocation. Jason, talk to us about asset allocation.
Yeah, so what asset allocation basically means is trying to put together a number of different assets and allocate them or mix them together in a way where you can kind of accomplish three main things. One is you're trying to accomplish the goals of the investor, what the returns that they're trying to achieve,
right.
But you also have to balance that with the risk that they're willing to take.
Okay.
And then also as part of that is time horizon as well. So the longer time frame, typically you can take a little bit more risk. The shorter time frame, a lot of times you take less risk.
Okay, so it's about creating a portfolio that doesn't have everything in one place, okay? And that's, in essence, the foundation of diversification. So talk to us deeper about diversification.
Yeah, so diversification is essentially spreading the risk around, okay? So, you know, everyone's heard the concept of not putting all their eggs in one basket.
Right.
So if you drop the basket and all the eggs are in there, all the eggs break. So you want to put your eggs in different baskets. That way if one of them goes down, so if one of your stocks go down or one of your mutual funds go down, you have others that will hold them up.
Hopefully, right?
Hopefully, that's right. So basically you're trying to reduce risk and still maintain a decent level of returns.
Now that's done in a couple of different ways, because you can have it all within the same asset class, stocks. You know, if one stock goes down, hopefully some others hold up, but also different asset classes like stocks versus bonds, right? Which I think is called non-correlated assets.
That's right, yeah. So basically, if you know, there's a bunch of different types of assets that we talked about in other lessons, but you have stocks and bonds. Those are kind of your main ones, but you also have alternatives,
right,
which may be like gold or real estate. You have cash. And in order to be successful at diversifying a portfolio, you want to have asset classes that are non-correlated. And putting those together, and what non-correlated means is when one goes up, the other one, or if one goes down, typically you have another one that goes up.
Okay.
And so it kind of cushions the blow. Let's just say, for example, a lot of times when stocks fall, like let's say the financial crisis, bonds went up. And so if you had a mixture of stocks and bonds, that held up better than just all stocks.
Right.
Okay? But you can also do that with alternatives and cash, and those are non-correlated as well. So a mixture of all of those together is kind of the key to having a good diversified portfolio.
And that'll vary depending on your asset mix, right? Some diversified portfolios can be higher risk than others.
Yep.
Okay. So that's where you really have to understand the underlying movement between the different asset classes. So stocks and bonds are usually inversely correlated. That's what you were talking about.
Yeah, which is what it says here on this slide. And basically, you know, just in general, the more stocks you have, the higher the risk.
Right.
The more bonds you have, the lower the risk.
Okay.
Okay.
So let's talk about how that's what we see the why, right? So let's take a look at that in like real life scenario, Jason.
Yeah. So I think this is just a really great chart, and what this looks at is a range of returns of basically you have in the green here you have stocks, in the blue you have bonds, and then in the gray area you have a portfolio of what's called a balanced portfolio, 50% stocks and 50% bonds. Now in this example we're only using stocks and bonds just to keep it simple, but as you can see here over that entire time frame, which is close to 70 years, in 1 year rolling time frames, stocks had their highest returns of 47%. That was their best year, but their worst year was a loss of 39%. And on the other hand, you can see bonds here had their largest gain was 43% 1 year, and their worst loss was 0.8% or 8%, excuse me.
Yeah.
And then a mixture of 50-50, you had your largest gain of 33 and a loss of negative 15. Now, it gets interesting when you go a little bit further out than 1 year. So if you have a 5-year rolling period, so if you go back in basically 70 years, and you take 5-year increments, all the different 5-year increments in that 70-year period, you can see here stocks had the greatest return in terms of the best 5-year period was 28%, but they did have some 5-year periods with losses, down 3. And so you can see the same thing with the bonds. Bonds had, their best 5-year average was a 23% average, but they also had a loss of 2% during one of those 5-year periods. But if you combine the stocks and bonds, okay, so 50% stocks and 50% bonds over the worst 5-year rolling period, it never had a loss. It actually had a gain of 1% during the worst 5-year rolling period, while still having the best time period during that was a 21% average return. So the point here, as you go further and further out to a 20-year rolling period, you can see that a balanced portfolio, worst loss was 5% and best gain was 14%. But the point of this is, during that entire period, even though stocks did 11.3%, which was the best return of all of them for that entire period, and bonds did 5.9%, a mixture of both actually averaged 8.9%.
Somewhere in the middle.
Yep, somewhere in the middle, but taking significantly less risk and having periods where even though bonds would typically be considered less risk, a blended portfolio where you had both of them actually had periods where it held up much better.
That's right. Now, we're not recommending any type of allocation. You have to consider what makes sense for you, what your financial plan dictates you need.
Right.
Because as you go further out, this is telling me, well, stocks were technically the best, okay, in terms of performance, because their worst 20-year rolling period was 6%. It was better than any other of the two blends. So, as Jason mentioned, the purpose of this exercise is to understand how a portfolio should be constructed based on your risk tolerance and your time horizon. Does that make sense?
Well, it's that, and it's just the benefits of diversification and the reduction of risk, along with that.
Which is usually volatility, because that causes the fear.
That's right.
And this is what people don't understand. And we have this quick picture that we did here, Jason, that you can talk about what people don't see that should be a real factor in how your portfolio is managed over time.
That's right. Yeah, this is an excellent chart right here. Very simple, but what we're looking at here is two different portfolios, okay? Portfolio 1 and Portfolio 2. And we're taking 4 years worth of returns, okay? So in Portfolio 1, year 1 you returned 15%, year 2 you lost 5, year 3 you made 15, and year 4 you lost 5.
These are hypothetical.
Hypotheticals, all right, just to make it simple so you can understand. And Portfolio 2 had a gain of 25% year 1, a greater gain, but then it took a greater loss. So it had a 15% loss in year 2. Same thing, year 3 it was up 25, year 4 down 15. Now, the average annual just simple rate of return, if you added up all those returns and divided it by 4, you'd see 5% for each of these.
They're both the same.
Both the same.
Right.
However, the volatility was 20% for the Portfolio 2 and only 10% for Portfolio 1. So kind of between the difference of the average returns that time, what was the high, the greatest return and the lowest return, was a difference of 10% for Portfolio 1, difference of 20% for Portfolio 2.
Which most people don't look at. They just look at what's my average annual rate of return.
That's right.
So two people with these portfolios would say, oh, we performed the same, 5% on average.
That's right. Yeah.
But did they really perform the same?
That's right. So let's take a look here. Now let's play it out. Let's start each one with $100,000. Same returns. Portfolio 1 is the top one. Portfolio 2 is the bottom one. And you go all the way across, and you can see by year 4 you have $119,000 for Portfolio 1. You have $112,000 Portfolio 2. And what you can see is happening is that on the years where the losses, it's losing significantly more during that time, and so therefore it actually ends up, if you have a compounded rate of return, the Portfolio 1 averaged 4.5 and Portfolio 2 only averaged 3.1%.
That's basically your effective rate of return, the reality of it.
That's right, exactly. And a cumulative difference is the portfolio that had the higher returns on the upside but lower returns on the downside actually was worse off by 5.7%.
That's just in 4 years.
That's just in 4 years. Now, if you go over to the box over here, after 20 years, you can see that it was a difference of 32%.
The same returns over 20 years.
That's right.
So they would look the same on average.
Right.
But what you have in your portfolio is very different.
Exactly. Yeah, so a big thing, to take away from this is a lot of times people will want to get the bigger returns, especially when markets are doing well.
Right.
And everyone wants to have a big returns when the markets are doing well.
25% versus 15 in this case.
Exactly.
Right.
So, but But what a lot of people forsake to think about is what happens during the bad times. And if you lose more during the bad times, it ends up hurting your returns over the long run.
That's right.
So you're better off with a portfolio, even if it misses out on a little bit of upside. If you can miss out a little bit on the downside, that portfolio will typically do better.
More steady Eddie type of approach.
Right.
That makes sense. These numbers show that.
That's right.
Now, the other thing is, another dynamic that we see people is they chase returns, Jason. They say, oh, look, gold has done this, or real estate has done this, or international has done this. So talk to us about that.
Yeah, so interesting chart here, very busy, very famous in the financial world. It's called the periodic table. So what it's looking at is a bunch of different asset classes. So each color represents a different asset class and the returns that they had for each year. And the interesting thing to pull away here is that you can see like EM equity means emerging market equity.
That's the light purple one there for those of us with bad eyesight.
So that's like stocks from Brazil and China and Russia and India, those countries. So they did really well from 2005 through 2009. But you can see from 2013 through 14, they were one of the worst performers. Same thing, into the financial crisis. REITs did really well prior to the financial crisis, but they were one of the worst performing sectors when the market took a big hit, and the real estate market took a big hit. So, and across the board, you can just see over time, some of the best performers end up being some of the worst performers.
Right.
And so what happens is a lot of times people will chase performance.
Right.
And they'll see a certain area, certain stocks that are doing really well, and they'll buy those stocks because of how they have been performing.
Right.
But the problem with that is usually after they've been performing well for a period of time, they usually end up taking a hit over the next time period. So what we're advocating is to have good asset allocation, good diversification, and have a mixture of all of these and constantly rebalance that over time, which we'll get into in another lesson, the rebalancing piece.
Right.
But more of a steady Eddie type of approach where you're getting consistent returns. You may not make as much on the upside, but you also won't take as much of a hit on the downside.
Yeah, and you can see that here. If you just basically held an equal portion of all these asset classes in your portfolio and then rebalance it to keep it equal every year, you'd have that white box, which is that steady Eddie right across the middle. Now, that's a simplified way of diversifying money, but it's better than not doing anything and not realizing what volatility can do to your portfolio. Does that make sense? So at the end of the day, guys, the goal here is to understand that diversification is crucial. It's a crucial piece for successful long-term investing. And what you want to do is to spread your dollars, among different asset classes and types that will help reduce the volatility, the risk, while also helping improve returns over long term because it did reduce the risk.
That's right. Yeah, that's right. Now, and a lot of times people, like I remember in the late 90s, they would say, oh, I had a whole bunch of stocks, but they were all technology stocks.
That's not diversification.
That's not diversification.
Right.
So you want to have different asset classes, different sectors, all the things that we talked about in the previous lessons to have real, true diversification.
There you go. So thanks for listening. We look forward to seeing you in the next lesson.